some of you, you've seen this yesterday, but just a quick intro for those of us who are joining us today. ADI, we are a boutique consulting firm focused on 3 markets: oil and gas, energy, and chemicals. Within these markets, we work across the value chain. So if you take oil and gas, for example, we work in upstream, midstream, fuels and refining. In energy, we work from generation all the way through distribution, transmission and distribution. A lot of the work in and around energy in the last few years has really focused on energy transition, and we're active in a lot of those areas. And then a few years ago, we acquired Chemical Market Resources, which has allowed us to significantly expand our coverage and research into the chemical space. We're actually celebrating 15 years in a couple of months. So we've had the opportunity to support over 300 clients over the last 15 years. It's a broad mix. We obviously do a lot of work with the large operating companies, both on the oil and gas and chemical side, but we also do support industrials, oil field service, EPCs, and then do a lot of due diligence work for the investor community, in particular the private equity investor firms. Our team is fairly technical in nature, so that has allowed us to do quite a bit of work supporting early stage companies, and opportunistically we have supported a number of public agencies as well. Lots of consulting firms out there. The way we tend to differentiate ourselves is with that deep industry expertise. Most of our team has worked in industry before they came into consulting, so you don't have to educate us on the difference between a BTU or an MCF when you engage us. We understand these things fairly well. The primary offering that we have is consulting work. So clients come to us with a question or a problem. We put a team around it and execute around it. Over anywhere from 4 to 12 weeks. That's the typical engagement model. But as we have grown, we have added subscription research, we've added an analytics platform with all the data that we have accumulated over the years that we license to clients. And then we organize this forum every year. So I'll run through the rest of this here, but there's a little bit more information that we can share with you. So let's get going on how we see energy transition. What are some of the perspectives that we have in this space? So first and foremost, right, again, 6 key messages that I'm hoping to leave all of you here with today. First and foremost, we still see oil and gas playing a fairly material role, right? Even in a net zero future, we don't really see oil and gas, completely disappearing, right? And I think increasingly a net zero future is, at least by 2050, is increasingly unlikely, right? We're probably going to see, in a best case, some sort of a rapid energy transition future. But, want to underscore the fact that oil and gas will continue to play a material role. The role of policy in accelerating energy transition, we're already seeing what's happening with IRA, right? And what's interesting is we are seeing funds flow through from the IRA, and that's going to be supportive of energy transition. But capital alone is not enough. We need people to actually commit to volumes of green hydrogen or blue hydrogen. We need people to build capacity that will accept offtakes from some of these projects that are being proposed. And obviously right now, as most of you know, that's where the bottleneck is. In terms of areas where we see a lot of traction in the near term, right, in the next few years, we'd say carbon capture is probably one of the areas where we think that we're going to see commercial adoption the most and the quickest. And then finally, I think our perspective is that most of the energy incumbents are underestimating the risks associated with energy transition. We obviously do see a number of incumbents move forward quite quickly and aggressively, but we also see a lot of incumbents still not engaging with energy transition, and that could pose fairly significant risks. So let's talk a little bit about all of this here. So very quickly, right, there are multiple energy scenarios out there. What we've done here is aggregate some of them, and if you look at the world in terms of 3 scenarios, in terms of how it will evolve going forward, there's a business as usual future, there's a rapid energy transition scenario, and then there is a net zero future scenario. And what we are showing here is the evolution of CO2 emissions across each of those scenarios and the temperature rise associated with it, right? So in a business as usual future, it's about 4 degrees centigrade above pre-industrial levels. In a rapid scenario, it's roughly 2 degrees, and a net zero future conceptually will get us to 1.5 degrees C. So we've run a bunch of models, and whichever way you look at it, right, the energy mix continues to have fairly material roles for oil and gas across these futures. So the top left is the energy mix in 2020. You'll see that about 60% is oil and gas, about a third is oil, about a quarter is gas. Now, if you take that energy mix and fast forward to, let's say, a business as usual future, which is the top right, half of it is still oil and gas. Gas gains share a little bit, but oil loses share predominantly to renewables, which grows roughly 4x, right, from the left to the right. Now, if you say that no, the world is going to move towards energy transition a little bit more aggressively, that's the rapid energy mix, which is at the bottom left. In that scenario, about half of that is renewables. Half of the energy mix is renewables. But oil and gas collectively are about a third of the total energy mix. And now you can see that gas starts taking a much larger share. It's about a fifth, and oil drops to about a sixth of the energy mix. And then if you say, no, we are going to get to net zero by 2050, which is the bottom right, we see about a fifth of the overall energy mix coming from oil and gas. Gas is about a fifth, and oil falls to about a little over 7% or so, right? So whichever way you look at it, right, even in a fairly aggressive view, we expect oil and gas to play fairly material roles even in a fairly aggressive energy transition scenario. I'll go through this quickly because IRA has been fairly well plowed by now. Everybody knows what it is doing, but obviously a pretty significant chunk of federal dollars that are available predominantly through tax credits and other incentives across a broad range of clean energy technologies and projects. What IRA really does is it essentially accelerates the break-even, the timeline to break even for a number of clean energy technologies, right? It essentially reduces the cost for these technologies to be competitive. And that varies depending on the technology that you're looking at, right? So solar and wind, for example, we are seeing roughly about 50% reductions in levelized costs of electricity because of IRA incentives. For energy storage, it's about 20%, and for nuclear, again, it's about 20% or so. Now, if you look at some of the molecules, or if you look at CCUS, for example, right, what it is doing is it is incentivizing different forms of hydrogen production, for example, of varying levels of carbon intensity, right? If you can produce green hydrogen that has very low levels of carbon intensity, you can get as much as $3 a kilogram in terms of the tax credit. Of course, what the Biden administration is doing is it has now proposed the details around how you're going to qualify for this, and that's where a lot of the debate today is centered on, in terms of how stringent it is to get that incentive of $3 a kilogram, right? Obviously, we expect some of that to be relaxed here once the public comment process is completed, but I think in many ways it's going to be challenging to get the maximum incentive that is available under the IRA for a lot of these projects, because the intent is to make material changes to the way energy is produced, as opposed to, let's say, make it fairly easy to qualify for some of these credits. On the CCUS, if you look at the CCUS tax credit, it's going from about $50 before to now about $85 a ton. Now, there's a lot of detail, and our team has spent a lot of time trying to understand exactly how each of these incentives are going to operate. we've been doing quite a bit of work with project developers. And for them, going into the gory details of exactly how do you qualify for the bonus credits, and all of that is very project specific, is very location specific, because, for example, one of our clients is sitting in an EJ sensitive area, and they can get about 5 to 10% more credit depending on their particular location of their project, right? So a lot of the incentives have been structured in a way where you can get bonuses depending on your ability to use local manpower. If you can increase the share of domestic content in your projects, you get another bonus. If your project is sited in a particular EJ sensitive community, for example, you have the ability to get an additional bonus. So when you stack all that up, right, you have fairly attractive credits and incentives that are available for a number of your projects. We also think that the IRA has made it very attractive for a lot of project developers to propose projects in terms of these taxes and these tax credits and incentives being transferable, making these incentives stackable, so you're not just restricted to an either-or situation, but you can actually build a project that brings multiple credits together. And the IRA also makes some of these incentives eligible for direct pay. In other words, it allows project developers to quickly float projects, get them to some sort of a proof of concept, and then sell those to other well-funded, well-capitalized investors to take those projects forward. So there's lots of interesting detail that has been embedded into the IRA that is very supportive of bringing a broad range of capital flowing into clean energy technologies. And in addition to this, right, there are some other interesting programs. The loan programs, the loan program office is fairly well understood, but Section 1703 is another interesting part that is not as well understood, which is that there's a significant chunk of change that the DOE is making available to existing oil and gas operators, refiners, onshore oil and gas producers. They can use those funds to develop clean energy projects. And we've had conversations with DOE, and they tell us how they're getting a lot of attention and interest and applications under Section 1706, and very little interest and discussion around 1703. So if you are an energy incumbent today, Section 1703 is a very interesting program to look at and see how you can use them to support some of your clean energy projects. The other thing that we are seeing is there's some sort of, because of the IRA, there's a significant amount of capital that is now flowing into the US, and this is compelling other parts of the world to look at similar versions, right? So Europe now has its own version of IRA for specific areas, CCUS being one, where the collective incentive that we are showing here gets up to about $97 a ton. It's interesting because that's very similar to the $85 a ton incentive that's available under 45Q, for example, for CCUS. Now, a significant part of this is made available through the EU ETS system, but it's still there. Europe is still sweetening the pot, sweetening the incentive, if you will, in order to make CCUS a lot more competitive, for example, with what the incentive structure under IRA looks like. We have similar programs that we are seeing coming up in Asia that are focused on incentivizing clean energy technologies that are essentially based on the IRA model. So given all of this, right, we do see capital flowing into the space. Now, is that sufficient is a different question. When we tally all the capital investment that is required for us to get to, let's say, a net zero future, that's roughly a little over $40 trillion through 2050. So there's quite a bit of capital that has to be deployed into this space. And in comparison, if you look at where we stand today, right, last year, for example, we invested a little short of $2 trillion in and around clean energy CapEx. Now, this includes a lot of clean energy projects. It includes a lot of renewable power investments and then things like that. So it's a fairly broad assessment of the capital that has flown into this space. If you take a small section of that and look at primarily early stage companies, that's the chart on the right, and that was about $30 billion or so. We do see some moderation of the capital that is flowing into this space, especially in early stage technologies. And you see that the investment that went in 2023, for example, was a little bit, was about 40% lower than what we saw in 2021 and 2022. But still, there's a fairly attractive set of capital that is seeking interesting technologies. And we see an environment that's still quite supportive of development of new clean energy technologies. Now, if you actually look at IRA dollars and see where they are flowing, we see roughly $80 to $90 billion worth of projects that have been proposed out there leveraging IRA dollars. A big chunk of that is centered in and around batteries in particular and energy storage. But there's the next big tranche is industrial decarbonization. Then, of course, you have some of the renewable power projects. So we do see capital flowing into the space. What is also interesting and heartening is that we are seeing a broader range of capital sources that are supporting some of these projects. So, for example, what we are showing here are some energy transition, clean energy technologies that have all proposed commercial projects. And the x-axis shows projects of varying size, right? I mean, this is the size of the capital investments that are being made in these projects. And the y-axis shows where they have raised their funding from. So you have some corporate investors, for example, that are investing in some of the projects that LanzaTech is commercializing. You have some private equity investors that are investing in some other technologies, and then you have some venture capital firms as well that are going further out and supporting some of these decarbonization projects. So I think what is interesting is that for a lot of these first-of-a-kind projects with very new clean energy technologies, they have been successful in raising capital from a broader range, from a broader stack than similar projects have in the past, right? So that kind of tells you that there's a lot of appetite in terms of investing in and around decarbonization projects, which is very different from, let's say, Clean Tech 1.0 or 2.0, right? So that's one of the big differences that we see that makes us optimistic. But anybody who works very closely with a clean energy project knows that capital alone is not enough. So hydrogen's a good example, right? So if you look at levelized costs of hydrogen and you layer on top of that the IRA incentive, what that tells you is that blue hydrogen is cost competitive today, right? The cost of making blue hydrogen today is roughly $1.75, $2 a kilogram. If you layer on top the 80-cent incentive, you can bring that down to roughly $1 or a little over $1 a kilogram, which is the price that most large-scale consumers of hydrogen are paying. So conceptually, blue hydrogen is competitive today. But if you go and talk to blue hydrogen project developers, they'll tell you how they are struggling to find offtake for blue hydrogen volumes, right? So I think that's an example of why, when you look at the stack of project announcements for green hydrogen or broadly speaking, low carbon hydrogen, there's a lot of announcements out there, but the number of projects that don't have a specific date associated with when they are likely to come on stream outstrips all the other projects that have firm dates in terms of their commercialization plans. So the chart on the left shows the project announcements for low carbon hydrogen. And you'll see that the last stack, which is labeled as unknown, is the list of projects that have been proposed, but they don't have a firm date associated with their commercial timelines. So I think that is one of the challenge here, and it's a fairly significant challenge in terms of finding customers, finding off-takes for some of these projects. Having said that, right, I mean, there are some interesting end-use cases where we are seeing a lot of activity. So the chart on the right shows ammonia production, blue and green ammonia production here, and what we see is that there's a lot of traction there, and a lot of these projects are finding offtake, they're finding partners quite well in comparison to, let's say, standalone green hydrogen project. So we've been spending a lot of time with these project developers as they conceptualize their projects, as they think about the economics. We layer in all the details associated with the IRA incentives, and what we are finding is that there is substantial interest and support in investors who want to pick up project developer equity, who want to find ways to support these projects. There's also quite a bit of interest in terms of longer-term power purchase agreements in support of some of these green hydrogen projects. It's probably not as strong as, let's say, providing and financing project developer equity, but it's still there. The biggest challenge is in and around offtake, right? Customer interest and drivers for green hydrogen. What we are finding is that the largest consumers of hydrogen, refiners are a good example. They seem to be far more committed towards blue hydrogen, and they are essentially waiting for some of this blue hydrogen capacity to come on stream before they'll commit to this. A slight difference to this is, at least in Europe, we see a little bit of an interest in and around green hydrogen, but it's still fairly limited, much smaller volumes, and primarily in the chemical industry. And then the last piece is the investor base is very worried about EPC risk. This is fairly new, I would say, but a lot of these projects have all been delayed, and we are seeing a lot more scrutiny of these projects in terms of what their commercial timelines look like, what do their schedules look like, what kind of EPC partners are these companies paired up with, and there's quite a bit of scrutiny there. So let's talk a little bit about CCUS. We've been spending a lot of time in and around CCUS. One of the earliest projects that we did about 3 or 4 years ago, and this is a chart from that, so it's a little bit dated, but we looked at every single source of CO2. We looked at the volumes, and we said, okay, what is the price at which these CO2 volumes could potentially be captured and stored? And obviously there's a curve here, and in general, right, I mean, if the CO2 concentrations are high, you can capture them at fairly low costs, and as the concentrations get lower, the cost rises, and direct air capture sits at the far right. So that's the stack. So it makes a lot of sense conceptually to say that we should be capturing CO2 from coal-fired power plants, we should be capturing CO2 from ethanol production plants, and so on and so forth. But then we started seeing a lot of interest in direct air capture. We did quite a bit of work for a couple of companies. Then we launched this multi-client study, and then as part of this, we went and spoke to a number of people who were buying offtakes in direct air capture plants. And a lot of these companies were companies like Microsoft and Google and some of these tech companies, essentially, right? And what we heard from them was very interesting, right? It changed our view and perspective, right? As a chemical engineer, when I look at direct air capture, the first thing that comes to my mind is, this is stupid. This does not make any sense. You should be capturing CO2 from the most concentrated streams. That's the most cost competitive thing. But when you take that perspective and talk to the likes of Microsoft and Google, who are actually writing checks, right, who are committing to financing some of these DAC projects, what we heard from them is that we have made commitments. So Microsoft, for example, has committed to its investors that they are going to get to a carbon negative kind of a situation by the end of 2030, right? So essentially, not only are they capturing all the CO2 associated with their operations, but they're going to be capturing more than that, right? So essentially, they're going to be carbon negative. So when they go and talk to the large coal-fired power plants, they go and talk to the large refineries and say, hey, we'd like to partner with you to find a way to reduce CO2 emissions. They tell them that, okay, it's going to be expensive. We're first going to do a FEED study, then we'll do FEL 0, 1, 2, 3, and we'll kind of get to some sort of a demo and pilot plant by 2030. Microsoft is not interested in that story, right? They want to get to carbon negative by 2030. So what they are saying is, we want people who are sharing our urgency for reducing CO2 emissions. And we want to invest in technologies, in a broad base of technologies that will move a lot more quickly. And to them, this idea that DAC is sticking a tower out there, and if you can develop the technology and commercialize it quickly, that resonates with them. So, I think there has to be something that has to be said for this voice of the customer, in this case Microsoft, right, who's saying that, hey, we need to move a lot more quickly, and the traditional CCUS technologies are not quite cutting it for us. So I think when we went through that exercise, right, I mean, this is a sentiment that we heard not just from Microsoft, but a bunch of other tech companies as well. If you look at the investor base for a lot of DAC technologies, a lot of them are these tech companies essentially, right? So that's what we heard, and that's the reason why you see so much capital flowing into direct air capture. Now, having said that, there are some fairly interesting, larger, more realistic, technically from a technical point of view, projects that are being developed. I see Lydia is here, so she'll talk a little bit about what ExxonMobil's doing in this space. But if you look at California, for example, CRC is building a very interesting business case as well in and around CCUS. In fact, if you look at the chart on the right, if you layer in the EBITDA projections, for example, for CRC and their CCUS as a service business that they want to build over the next few years, essentially capturing CO2 and providing storage and transportation options. The multiple on that, $250 million of incremental EBITDA from the CCUS as a service business is almost 3 to 5x of the multiple that they have today on their oil and gas business, right? So in many ways, right, there's a lot of investor interest and appetite for a lot of these projects, and some of these projects are getting closer to at least some sort of a commercial proof. The last thing is, we do think that incumbents are underestimating the risks associated with energy transition. I mean, if you were here yesterday, right, there was a fairly robust discussion around the need to provide energy at cost competitive prices and in a cost competitive fashion, and how the world continues to need energy. But I think if you look at energy forecasts, right, this traditional view that energy demand will continue to rise in an inexorable fashion through, let's say, 2050 is probably something that we need to look at a lot more carefully. So we've been doing a lot of work looking at energy efficiency, and what we are finding is that even with modest improvements in energy efficiency, you could get to a point by the end of this decade where energy demand will stagnate, or it'll grow at very, very low rates, right? And that's what we are trying to show here. In a business as usual scenario, yes, energy demand will continue to rise. But in a rapid and net zero future, if you assume energy efficiency improvements, we could get to a point where energy demand will not grow as fast, may potentially stagnate, right? So if that happens, you don't need as many people developing energy resources. You don't need as much energy as much power generation or oil and gas production capacity out there. So essentially, what that's going to do is it's going to push a lot of companies that are on the far right of that supply curve out of business, and that's one of the key risks that's not well understood. Another example is looking at levelized costs of renewable power, for example, right? For the last 10 years or so, if you look at levelized costs of power, they all have been quite competitive to gas-fired power generation. In some cases, we see renewable and solar power being cheaper than gas-fired power generation. But the standard criticism of a lot of that analysis has been it doesn't take into effect the firming cost, right, which is the cost of a battery that's required to fill the gaps associated with power demand when the sun is not shining and the wind is not blowing, right? So Lazard recently put out their study on LCOE, where they took the cost of LCOE and then they added the cost of energy storage so that you essentially get a firm power output that can meet various needs, right? And that's what we are showing here. The chart on the left is for solar. We'll use that as an example. And this is across different ISOs, right? I strongly encourage all of you to look at this Lazard study, very detailed, and it has data for every single ISO, but we've aggregated all of that here. So what you can see is that even after you add the firming cost, right, at the low end, you're potentially a little short of $75 per megawatt hour, right? Which is very competitive to gas peaking and even gas combined cycle power generation, right? So that in some ways tells you that this traditional argument that when you factor in the cost associated with firming up renewable power with energy storage is not competitive to gas-fired power generation is no longer true. We are doing a study right now on how electric utilities in Asia are responding to ESG and sustainability pressures. And what we are finding out is that in the last few years, the fastest growth that we are seeing in smart meters is actually in India. And the cost of these smart meters is coming down. And essentially, a lot of smart meter companies are now looking at India as the place where they're going to see near-term growth, right? So conceptually, that does not make sense, right? Because India is a very price-sensitive market. And yet, there's so much interest in some of these technologies because it offers significant cost reduction potential, and it works very well with some of the other broader programs around renewable power generation, for example, that are being implemented a lot more aggressively in India. So this traditional argument, right, that the emerging economies are going to need a lot of energy, and therefore, we are best positioned to supply that. There's quite a bit of truth to that, but I think you also have to recognize that there's a lot that is changing, and these are risks that I think we sometimes tend to underestimate. I'm being told I'm short on time, so I'm going to skip through some of this, but let me pause there and see if there are some questions, and we'll get into the conversation with Chuck here shortly.
Uday, when you talk about the different energies and power opportunities for us, you talked about some of the costs. And so do you see in the analytics anything related to the reliability of these systems and how that might impact the energy transition?
Yeah, that's a great question. In some ways, right, this analysis here that I was sharing, the whole issue of firming up some of these renewable power sources, right, is in some ways focused on addressing that reliability question. Energy storage by itself, right, we haven't, some of that also needs to be stress tested even just with energy storage, right? Because we haven't been, we don't have energy, we have some markets where energy storage is fairly substantial, ERCOT being one, but there are lots of markets where we haven't quite seen energy storage being a fairly large piece of the mix, right? But the broad view is that energy storage is going to help us address the reliability of some of these power generation technologies, but I think we just haven't stress tested them enough, right? I mean, just as part of this study that we are doing on sustainability and sustainability-related implications for electric utilities in Asia, what we are finding is when you go and talk to the utilities in North America and Europe, they all talk about how their investments are focused on improving reliability and redundancy of the grid. But when you ask the same question around reliability and redundancy of utilities in Asia, they don't see that as an issue. They don't see that as a concern. And I think there are two reasons for that. One is I think some of their grids are newer, so they don't quite have the same challenges. And second, culturally, they have been in an environment where there are not a lot of expectations around the reliability and redundancy of the grid, right? So I think those are a couple of factors. But I think some of that is TBD, right? I mean, we just have to see how these systems are going to perform when in the wake of significant stress on them. Maybe one last question, otherwise we'll jump into.
Yeah, thanks, Uday. Steve Brown over at Chem Stations. We have a bunch of customers and partners in Japan, and they're telling us that there's a government push to move to ammonia, so that they're using the hydrogen to make ammonia to reduce the safety risks of storage and moving the hydrogen, using the ammonia as combustion fuel. So I'm curious if you've looked at that. Is that a competitive solution? Is anybody else outside of Japan looking at it, or are they on an island unto themselves?
Yeah, I mean, the whole issue of sourcing hydrogen in the form of hydrogen carriers, right? Japan, probably Korea to a certain extent, and Australia have been at the forefront, right? I mean, they have been talking about that. Probably Japan is one of the first countries that has a firm policy around it that's incentivizing at least a lot of early development efforts around that. We don't quite see, at least we have not seen similar, the same degree of interest in other parts of the world, right? But I think, Steve, I think this is another piece of the broader energy transition story, right? We have been looking at energy in terms of the traditional lens, which is there's going to be fairly large material market share that different energy sources or technologies will have, right? So oil is going to have 60% and gas will have 35% and all that. But I think the energy transition, let's say we get to some sort of a rapid energy transition into 2050, I think what we're instead going to see is a very fragmented energy landscape where probably a lot of these technologies won't have more than 10-15% market share. So if somebody like Japan is looking at ammonia as a hydrogen carrier, I mean, Japan consumes substantial energy, that it could be a fairly interesting, viable commercial model there in terms of developing ammonia as a hydrogen carrier. So I think what I would say is that just because other countries are not looking at it doesn't mean that you could build a fairly successful, commercially viable business around supplying hydrogen in the form of ammonia into Japan. The cost is going to be higher than, let's say, whatever the most competitive alternative today is natural gas, probably. But there is a willingness to pay in some of those markets a premium for clean energy.